Alright, so welcome back. You're watching the ET Money Show with me, Kavita Thapliyal, and there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? Now, to help you navigate through this maze on the ET Money Show today, we are joined by Arnav Pandya, founder, Money Edu School. Good evening, Arnav. Welcome to the show. And before we begin our viewer queries, just one quick question, because in the previous segment I was talking to a travel expert who was advising people to just rush in and get your travel plans, booked now, because if you delay further, it will be difficult for you to, have a vacation for this year end. What are a checklist, maybe, if someone wants to follow if they are going to book tickets now when the prices have almost doubled?
Good evening, Kavita. So, if you are looking for a last minute deal as far as your travel is concerned, then a few things that you might want to look at. One is that when you're trying to book a ticket, what is the time at which you are looking for the travel? Because you might find that the fares have gone sky high for the popular destinations at the normal booking hours. But if you say you select a flight which is slightly late or very early in the morning, you might get a good deal for it. Second thing is that when you are looking to book a ticket, see whether a direct flight is a better option or a stopover at some other place which is not very popular. That might get you a cheaper deal. Especially this is mostly true for international travel, because if you transit to a not very popular place, you are likely to get a better option. And third and most important is that always try and check several airlines before you come to a final decision, because it could be that one of the airlines is giving you a specific deal and which might at least lower your cost. Because see, if now if you go and try and book a holiday or a travel at this point of time, you are going to face sky high fares. The only thing, the question that you need to answer is that how are you going to lower it as much as you can?
All right, so that's something you should really note down if you're booking your tickets now for a New Year holiday. We will move on to our first caller, who is Devraj. Hi, good evening.
Hi.
How are you, Devraj?
Absolutely fine. Thank you.
Thank you so much for sending us your query. You have a multi-cap and a flexi-cap fund, and both are doing well for you. Now, you are concerned about the market uncertainty, and you want a steady income from this investment, and for that, you want a debt fund where you want to park in your money for 6 months or a year.
That's right, yes.
All right. You also want to understand the tax treatment involved if you invest in a debt fund.
No, my question is, I'm looking for an alternative to a savings bank account where there's no volatility and one gets more than 3% compared to what a savings bank account gets.
All right. And you have not parked your money anywhere in any fixed deposit, right?
No, not at the moment.
Perfect. So Arnav, I think he's pretty clear about what he wants. He wants to park his money in a debt fund for almost 6 months or a year. And what kind of a tax treatment would be applicable on the kind of debt fund you will be recommending. But then when we talk about debt, there are almost 16 categories. And so looking at the kind of interest rate hike that we are seeing, which are also, which might be, we can see it continuing for a few quarters as well, in a slower pace maybe. What kind of a debt fund can one really opt for?
See, there are 16 categories of debt funds, but each of them is distinct and they address a specific need of the investor. So, in that sense, if you are clear about the goal that you have, then the choice also becomes far easier. Now, if, for example, you are looking at just an alternative to a savings bank account where your goal is very simple, that you want to earn slightly more than 3%, then the obvious choice is that if you are going to say transact frequently or withdraw money at very short periods of time, then a liquid fund is the right option for you, because what happens is that you can use a liquid fund right exactly as a savings bank account. The only thing is that the returns on a liquid fund you will not know at the time of your investment, because liquid funds invest in a very, very short duration paper. So depending on the liquidity position in the debt market at that point of time, one will see the returns on the liquid funds vary. For example, during COVID times, because liquidity was so high in the debt markets, because the RBI had pumped in so much amounts, the returns on liquid funds had also come down to 3%. But now, as we see interest rates rising in the economy, liquidity getting tight, the rate of return on these funds has also inched up closer to 5%. So one can see that depending on short-term movements in terms of liquidity, returns are going to fluctuate for liquid funds, but they are obviously the best option as compared to keeping money in a savings bank account. Now, as far as the tax treatment is concerned, whenever you withdraw money from these funds, the gain that you have, which is the difference between the cost price of your units and the sale price, that will be considered as a short-term capital gain because you have held the units for a period of less than 3 years. And that short-term capital gains will be added to your income. So in that sense, there is no difference between the impact of the taxation on a savings bank account where the entire interest is taxable. But one thing is you need to keep in mind, for a savings bank account, up to 10,000 rupees of interest in a year, you are allowed as a deduction. So that is one thing there which you need to make use of. In case of a liquid fund, the good part is that you are getting a higher rate of return. So even after you consider a part of the gains, the net return is most likely to be higher than a savings bank account. So that is the plus point for a liquid fund. Now, if your goal is specifically to invest for a 6-month period, because that period is slightly longer than just a few weeks or so, in that case, you might want to look at an ultra short-term debt fund, which is suitable for this time period. So a very clear distinction you need to make in terms of your investment horizon and then make the choice. But if you are going to operate the amount like a savings bank, then a liquid fund is a better option.
Raj, are you clear with the suggestion given to you? Anything else you want to ask?
That's absolutely fine. Thank you.
Thank you so much for sending us your query. We move on to our next viewer, who is Sanjay, and he is doing an SIP of 70,000 per month, and the horizon is 10 to 15 years. Now he wants to retire and retired 58, and he wants to know what will be the corpus if he continues investing for 10 to 15 years, and the amount is 70,000 per month. He wants to begin his investment. Actually, it would have been nice if he was there on the phone line with us, but then I also wanted to know if he could increase the SIP amount. Approximate how much would be the amount if he doesn't increase the investment amount and just sticks to 70,000 per month for 10 to 15 years?
See, one is that one needs to make a couple of assumptions in this point, because 10 to 15 years is a bit of a difficult thing to do, in the sense that the time period is such that you might actually double your money in that time period because of the benefit of compounding. So, for example, if you take a period of 15 years, which I'm saying because that's more beneficial, you've already done the hard work of investing for 10 years, you might as well invest for 5 more and reap the real benefits of compounding. So if you invest, say, this kind of 70,000 a month for 15 years, and it grows at a compounded annual rate of 12%, you should have something in the range of 3.5 crores. So that is a rough ballpark figure that one can look at if this kind of investment is continued. And since it is a very long time period, one is looking at pure equity funds to construct a portfolio. The other good thing is that if you have this kind of a large amount of 70,000, you can have 5-6 funds in the portfolio across various market caps, which will ensure that you are able to take only that much risk which you want to, but at the same time get the benefit of equity. And the benefit of equity is that it grows over a longer period of time, and the longer you stay invested, the more the benefit of compounding. So, for example, if the investment is taken out after 10 years, then the investment period also comes down significantly. And more importantly, the chances are that you would not even cross 1.6 crores in terms of the corpus that you have built. So the real benefit of investing for a longer period of time comes for the longer time period you stay invested. So you can create a very good portfolio, well-rounded portfolio with a large cap fund, uh, uh, large and mid cap fund, a flexi cap fund, a mid cap fund, and a small cap fund with this amount, and that will ensure that your goals are met.
Also want to understand this approach, where Sanjay is really not clear about what is the corpus amount that he wants to have for retirement. When you are planning a goal, which is your retirement goal, it's very important to do a back calculation where you have to count in the expenses that you have currently, the kind of income that might just get reduced at the age of 58 or 60 or whenever you want to retire. You have to, quickly do a check-in with your debts and your liabilities. So Arnav, how can one go about it? Because retirement, in terms of lining up your goals, should be your first goal that needs to be decided.
You're absolutely correct, because retirement has to be your first goal. It will be the biggest goal, and it is very important because you don't want to be in a situation where you run out of money at a later stage in life when you are not able to earn an income to replenish the corpus. So three very important factors which complicate the retirement calculation, and which is why every couple of years you need to rework the calculations to ensure that your retirement goal is in sight. See, one is the time period for which you will want to use the corpus. So that if it could be 25 years, 30 years, depending on when you retire. So that period is very important because you should not run out of money before this time period. Second is your expenses which you will incur during retirement. This requires a bit of forward thinking, and you need to know exactly what is the kind of lifestyle you want, what are the kind of expenses that you will be incurring. So that is dependent only and only on every specific individual who's doing the retirement planning. Third and most important, which is a very tricky thing, is the rate of inflation. Because say today you might be say spending 30,000 a month on various expenses, but the rate of inflation over the next 20, 25 years, and even after that, that can mean that the goal which you have set today becomes inadequate at your retirement period. So that is very important. Always consider a slightly higher rate of inflation in your calculation, because that will make you want to have a bigger corpus, which is a good thing because it has to last for a very long period of time, since one as an individual is now living longer. And apart from that, there are many people who actually want to retire a bit earlier. So that actually increases the time period for which your retirement money has to last. So ideally, what many people do is that they get a figure in their head, say 2 crores or 3 crores, which they think is a very big figure today, but it might not be a big figure at the time of your retirement and thereafter. So always take these three factors into consideration. And it's also important to keep revising the calculation, because times change, inflation changes, situations change, so which might require a change in your planning also.
All right, let's move on to our next viewer, who is Ashish, and he wants to do a long-term SIP in an index fund or a blue chip fund. Now, that's a very interesting question. Looking at the kind of underperformance which is actually seen in large cap funds, do you think it's better to opt for an index fund right now, or because Ashish is talking about a long-term time horizon, so maybe he can look at an active large cap fund?
This is the most common point of debate which has been going on, because blue chip funds are large cap funds, and large cap funds have been defined as those funds which predominantly have their investment in the top 100 stocks by market cap on our exchanges. So if you see the last few years, you will find that large cap funds have not been able to beat the benchmark indices. So which is why you find that a lot of people are also moving towards index funds. But if you ask me, I think that the Indian market still has potential for fund managers to give you an extra bit of at least 1.5 to 2% of alpha, even for large cap funds over a longer period of time. So if your horizon is long, one can still go in for an active fund. The only caveat here is that if you are looking to have an active large cap fund in your portfolio, you will have to put in some extra effort in terms of monitoring, in the sense that if you are buying an index fund, you buy it, forget it, you don't need to look at it after that. But if you are buying an active fund, you will have to monitor its portfolio every 6 months, 1 year. Keep looking at how the fund is doing, whether it is sticking to its mandate, whether it is doing well. And it could be that after a few years, you might have to change the fund. So, there, just buying an active fund and forgetting about it will not be the right approach. So, if you are able to do that kind of bit of slightly extra work, or you have a planner who does it for you, then according to me, one should actually going for an active large cap fund.
What's exactly the reason? I mean, can you also name the biggest underperformers in this active category, active large fund category right now?
So one of the main reasons for this is that if you see the large cap indices, often because they are weighted indices, which means that some companies have a larger weight in them, you find that just a movement of a few top companies in the index gives a push to the value of the index. Now, if those specific companies which are boosting the index are not in the fund, or they have a slightly lower exposure to the fund, then you will find that the fund is underperforming. Similarly, you find that couple of sectors, specifically banking and finance, as well as IT, they have a large weight as far as the index is concerned. Which is why, I mean, you will find that most of the large cap funds also have a large exposure to this. And that exposure is not always exactly in tune with what the index exposure is. So that weightage, if either of these sectors underperform, or some companies, leading companies in the sectors underperform, then the funds will also underperform. And that is exactly what has been happening for a long period of time. The banking sector was not doing well. Now it's the IT sector which is not doing well. Funds which have higher exposure to these sectors, they have not been able to outperform. So the moment things change, you will find that good performing funds will suddenly start rising in terms of the return that they give. And which is why one always has to look at the fund manager, the strategy that they are following, and the kind of weightage that they are giving to the various holdings in the portfolio. Because relying too much on a few stocks might lead to a temporary period of outperformance, but it might not last long.
All right. So to sum up Ashish's question, what's the solution for him? If it's an active large cap fund, then which one?
So, I mean, my choice for that would be either Mirai Large Cap Fund or SBI Blue Chip. Both of these are good funds, and either of them can be selected for the portfolio.
Fund, he can just take it from any AMC?
No, so I mean, these two funds, I mean, you can go directly to the AMC and buy them, which will be a direct way of investing. Or if you are using any platform, they both of them are available. Or if if you're asking about the index fund, any index fund is fine, because all of them are virtually the same.
All right. Next question is from Geeta. She says that she's investing 10,000 per month, and she's holding ICICI Pru Equity and Debt, IDFC Equity Hybrid Fund, SBI Nifty Index, Nippon India Small Cap, Tata Digital, and she wants to hold this portfolio for 15 years, and she wants to earn almost 1 CR from this portfolio.
So if you look at the portfolio, the time horizon for the portfolio is a very long 15 years. This gives you adequate time for the portfolio to rise, compound, and actually grow your wealth. Now, the problem with the portfolio is that you find that there are two hybrid funds which are there. Now, hybrid funds invest in a mixture of both debt and equity. So there is a large part or other in these funds which go towards debt, which for this kind, according to me, for this kind of long period, it is not required for a specific goal. Now, if the investor is using these hybrid funds to make up for the debt exposure in the overall portfolio, that is one thing altogether. But if you have a specific goal for which you are allocating funds, then for this specific goal only, two hybrid funds, which is a very significant part of the overall portfolio, is not the advisable thing. So in that case, my choice would be that you shift to a pure equity fund, at least as far as this goal is concerned. So these hybrid funds can be replaced with pure equity funds. And what I see from the whole mix is that a mid cap fund is missing, even a flexi cap fund is missing. So these two funds can be added in place of the two hybrid funds which are existing currently.
All right. Now, talking about hybrid funds, I don't think people really understand the purpose of having a hybrid fund. A lot of time people think it's actually to balance out the volatility that they might face in equity asset class. But then we have a lot of category in a hybrid under the hybrid umbrella also. You know, where one can be conservative category, one can be an aggressive hybrid fund. How can one actually opt in for the hybrid category depending on their risk appetite and the goal aligned with their portfolio?
See, you have asked a very important question because this is the crux of actually selecting a hybrid fund. So, for example, if people are unsure of what they should do, when they should move between debt and equity and all, they can go for balanced advantage funds where the decision of how much and when to move from debt, equity, and the proportion to be allocated is with the fund manager. So, you are giving the fund manager the whole responsibility. If you as an investor are very clear that you want just a very small portion, say, of debt in the portfolio, then an equity oriented or aggressive hybrid fund is the route to go, because there you will find that debt is a very small part. It only gives a slight bit of reduction in the volatility, but it will not impact the overall kind of returns that the fund is able to generate, because equity dominates the debt returns significantly. On the other hand, if you want a very small portion of equity to just boost the return of a debt fund, or rather a debt portion, then something like an equity savings fund is for you, because there the equity portion is very low. So your goal is very important. If you are able to take some volatility and you just need a slight bit of debt, then an aggressive fund is a far better option. But if you are just taking a small bit of equity for your portfolio, then the conservative type of hybrid is far more suitable for your requirements. People don't seem to realize that there is so much variation within the hybrid funds that you can actually tailor make it for your requirements and your needs exactly as you want it to be.
All right. We quickly move on to our next viewer, Samir, who's investing 11,000 per month. You have the funds on you, and he says that he has a very high risk appetite, and he's looking at building a corpus over here. And okay, I lost the question. Yeah, so he's looking at building the corpus of okay, the corpus amount is not mentioned over here, but he wants to build a good corpus before he turns 50. He's currently 26, and looking at the age, he's got two tax plans. One is from Quant and one is from Mirae Asset, and two funds, one small cap and one blue chip equity from Canara Robeco.
So if you look at the portfolio in that sense, there is a large cap, there is a small cap, and there are two tax saving funds. Now, the only question here is that since he is young, he can be a slightly more aggressive investor. He should be not looking at locking up too much money in the tax saving funds unless it is required for tax saving purposes. So, for example, if he already has a provident fund and other investments or other payments like insurance premium, which is covering the 1,50,000 limit under Section 80C, he should restrict the ELSS amount only to the extent to which it is needed. So the other thing is that two tax saving funds again are not required. A single tax saving fund will do the trick in terms of the portfolio exposure. And the third thing is, what is missing is a mid cap fund. So he should look aggressively in terms of raising the amount that he's investing and then adding a mid cap fund with the extra amount so that the portfolio becomes slightly more balanced. If even additional amounts are added, then he can later on look at a focused fund, which will be a good addition to the portfolio. But for the existing figure, you can see a mid cap fund is missing, that should be added, and only restrict yourself to a single ELSS fund.
All right, so that's the answer for Samir. And then last question is from Amol, and he says that a flexi cap fund or an index fund, what will be better? And he wants almost 12 to 15% returns over a long period of time, and he wants to know if he can invest in UTI Nifty Index Fund or a flexi cap.
So again, as we discussed with the large cap funds, the flexi cap fund is likely to give you a slightly better return. Also, it will generate alpha because of the fact that in a flexi cap fund, there is no restriction for the fund manager in terms of exactly how much exposure to take to large caps, mid caps, and small caps. So there is always a mixture of it. But we have seen typically that 70% of the portfolio of such funds is around into large caps, and there is around 20% into mid caps, and the remaining into small caps. So outperformance from flexi cap funds have been seen regularly ever since the category has been created. So that is a past history, but one can expect outperformance just for the specific reason that there is also a dash of mid cap and small caps in the portfolio. Second thing is, if you are looking for an index fund, I mean, as said earlier, any index fund is good enough. Only thing you need to choose is which index you are going to track, and that is important. And third thing is that my choice would be a flexi cap fund as compared to an index fund because you are likely to earn up with a higher returns. And just one thing in terms of the returns, stick to looking at a 12% return rather than a 15% one. You might get a 15% return over a period of time due to good market conditions, but always have lower expectations, which are reasonable, because that is the way in which one should at least plan your investments.
All right, so that will be all. Thank you so much, Arnav, for being on the show and helping our viewers with their finances. And on that note,